Thanks, Matt, and thank you all for being here on this great afternoon. So I appreciate you guys sitting here in the dark instead of being outside in the sun. So I wanted to talk a little bit about Bamboo Equity Partners and show you how our company creates returns for investors like you. I'll be very brief, and I will try not to sell you on anything. The only opportunity that I would like is to meet you, talk to you about it, and show you, again, what we do. So there's a lot of different managers out there, asset managers and fund managers, but really what separates our team compared to the other ones is this word grit. Angela Duckworth just wrote a book about it, and there's been a lot of studies done on it. And what they're saying is really that talent is not a good indice on whether a manager is going to perform well, but really the passion and grit and perseverance is. And I think that's what separates our team and what we do. We don't do any glamorous projects. We don't do anything that's financial engineering. What we really do is we really take great real estate in a great part of the town that has been mismanaged one way or the other. So a little bit about Bamboo Equity Partners. Bamboo Equity Partners was started in 2012 as really a loan servicer, for example. The banks in 2012 had their balance sheets full of REO assets, and they didn't know what to do with them. And so they started reaching out to people and trying to figure out, what do we do with this? We don't even know what the value is. Do we sell it right now? Do we keep it on our balance sheets, which banks don't want to do? And so they reached out to us, and we received a contract with about 40 banks to solve their real estate owned problems. And that's how Bamboo really started. We started as a consultant to the bank, and then we noticed, well, why don't we start buying these assets ourselves on a pennies on a dollar, because they're really trading really low. And so we started Bamboo, and since then we've created 24 single partnerships up until this fund that we're currently investing in. We have a 40-person team in St. Louis that is anything from property management, property accounting, leasing, construction management. And then we cooperate with, for example, Redwood, who is our fund administrator. Our fund is audited fund. So we have Clifton Larson Allen auditing our fund every year. And for a small fund our size, that's a really different maker. So you guys can see, here's kind of a quick overview of our fund. 2% management fee. We pay quarterly 8% return. We start splitting after we return the capital and reach the 8%. And minimum investment is $100,000. So a little bit about our strategy. So we have done a lot of research on this, because what we started seeing changes in real estate markets. The real estate markets are not today same as they were before. So we started doing research, and we figured out what assets and what classes of assets do institutions ignore. And that's how we came up with microcap. We invest in assets that are under $10 million in purchase price. That doesn't mean after we're done with them, they're called micro assets anymore, because we like to put them together in a portfolio and then offer them to institutional buyers. But what we like to buy is we buy assets that are under 10 million that none other institution wants to go after. And if you guys look at it per Preqin, these smaller funds and smaller assets have overperformed all the other managers. And so we, in order to confirm our theory, we hired Washington University in St. Louis to confirm my investment thesis. And so if you guys would like to, on our booth, we have Washington University paper explaining how the IRRs on smaller product outperform larger product. The other thing that we like to focus on is location. We don't do anything that's really out of 5-hour drive from St. Louis. We want to be next to our assets. We want to look at them. We want to touch them. We want to make sure there are experts can reach them within 5 hours. The other thing that we don't do is we don't invest in primary markets. Primary markets, again, are competitive. Institutions have too much money and they come and attack. However, also, secondary markets that we invested, they have a lagging effect, meaning you can see what happens in a primary market and then you can react in a secondary market. Great example of that was the Great Recession. In St. Louis, for example, we knew a year to 2 years in advance when everybody else was going down. St. Louis didn't, but a year or two later, it started going down as well. And finally, we're value-oriented. Because of our management team, we can add the value to all of these assets through construction, management, leasing, and again, through our pipeline of brokers, we're able to find assets that are chiefly ignored by everybody else. So a little bit more about microcap and why microcap. You guys will see some statistics over here that are pretty unbelievable. For example, $20 billion was raised for real estate investment funds in 2018, the first half of 2018. The average size of a real estate deal is 48 million. Our average size is 6 million. And so all of these institutions are fighting for same assets in same markets. Why? There's a better way. Again, location focused. St. Louis a lot of times gets overlooked for its location. But if you look at it, there's quite a few great things going on there. St. Louis per SBRE was named number 6 projected rent growth market in the office industry, and then 15th globally. If you look at it from the employment perspective, St. Louis was ranked number 2 in a number of small business growth. Forbes ranked it as a number 10 rising city for startups. The other great thing about St. Louis that we have taken advantage of is all the biotech startups. As we're located in the middle of the country, all the biotech is really starting to happen in St. Louis. Ag tech, biotech, there's more than 700 biotech companies in St. Louis. And then I'll skip some of the other ones, but you guys also need to know that it's one of the number 1 beer scene cities in the United States, so come and visit. So I wanted to show you guys our value-oriented investment style. If you look at it, the gray boxes is really what the market prices are per square foot. If you look at the colorful boxes, that's where Bamboo has been buying in. So as you can see, we have stayed the course from 2013 all the way to today. We have stayed the course buying way below market. And then through our property management, leasing, we're able to lease up these things, fix them up, and sell them really quickly. So here's some of the assets in our funds, and I'm gonna dive a little bit deeper into some of them, but you guys can see that there's 5 assets currently in the fund. The fund is actually closing in June of this year. We're raising $20 million. We're at about $15 million currently, so we're going to be raising $5 more million to close it in June. It's probably going to have 6 or 7 assets total, and all of these assets currently are coming through our process of fixing them up. So here's an example of something that we do. This is a perfect example how we work with with outside people to bring assets to us. This property was owned and leased by a local developer, and he started pulling the money out of the property and invested it into other properties. The life insurance company who had the loan on this property, they figured it out. They noticed that he wasn't putting money into the property. It was being dilapidated. And so they called us up and said, will you guys come in and step in on this loan? So we came in and stepped on the loan. We assumed the loan. The old borrower lost all of his equity. And if you look at it, the price per square foot on our acquisition on this was $72 a square foot. The market price for similar assets in this market is $266 a foot. As the other matter of fact, we assumed this loan at an 11 cap on the existing income, while we still had 26% leasing upside in this building. But again, one thing that I want you guys to look at is, look at the differences between the rents that this owner was getting compared to rents that the market was getting. Look at the difference in where the owner was in terms of vacancy compared to where the market is in terms of vacancy. This is really what we're good at. This owner did not know how to operate this building, and that's why the building was empty. He was paying a person to sit for $60,000. He was paying him to sit and open an arm to let people in into the parking lot. For $13,000, one-time charge, we installed a new electronic arm, and now we're receiving $9,000 a month in parking charges. So that's simple things that very good managers do to raise the value of the asset. The next asset in our fund that I would like you guys to point out is Ballast Place. This building is located in one of the premier markets in St. Louis. It's an institutional market with Microsoft, Aon, Lockton, all the big companies right next to this. The owners were multifamily owners, and they never owned an office building before. We received a call from the bank that these owners are about to try to refinance. Because of the rise in interest rates, their interest rate was going from 3.3 to 5.3%. And the current rent roll on this property was not supporting it. They tried to go to a different bank and refinance. They were not able to. So again, we got a call from the bank and said, hey, would you buy this from us? And we're going to do a short sale. And so we purchased this property at $63 a square foot, where the market prices in this area are $144 a foot. The owner had to come to the closing with about $800,000 to make up for the difference, and we took over the loan. So again, just like in the previous example, the rents in this area are $21 a square foot full service. This owner was receiving $16.61. The market vacancy is 11.4. He was at 26% vacant. And the biggest thing, again, that's a repeating factor with us, we buy on the existing NOI. No matter how empty the building is, we buy on the existing NOI. So our cap rate on an existing NOI on this was 9.31%. Finally, I'm going to conclude with some other case studies of what we have done over the years and show you kind of the performance that we have been able to achieve. So another building that we purchased from the bank, Old Dorset Road, on a corner of Highway 270 and Dorset Road in St. Louis. What we were able to do is buy it when it was 68% occupied from the bank and lease it up to 91%, turn it around within 2 years and sell it for about a 22% IRR, 1.68% equity times, and meanwhile we were also paying 8.3% annual preferred return to all the investors. Another property that we bought from the lenders, we bought this from a big loan servicer. We bought both of these buildings from L&R. One was 44% occupied, the other one was 48% occupied. We leased them up, put them in a portfolio, and sold them to an investor from California at an A cap. Now, some might say, well, ACAP is really kind of high, right? But for us, it really doesn't matter. For us, what mattered is that we really didn't put any equity into these two buildings. And we were able to sell them a year and a half later for $1.6 million profit. So, if you guys have any further questions, we're here the whole weekend, so please stop. You guys will probably, you cannot notice me. I'm a little bit taller than average person. I can tell you a little bit more about my basketball stories and wounds. But please stop by, say hi, and we'd really love for you guys to meet myself and my partner Alice, who is in the back as well, and we can have a conversation on how we can work together. Again, we love investors, we love finding new investors, and we love working with them and trying to realize what they're doing. So, thank you.